So as many people know, I came up to New York from Maryland in 2001 after graduating from law school. And I started work at the Manhattan District Attorney's Office on September 4th, 2001. What happened a week later and what really set my career on a much different course was built out of tragedy. When I was a private practicing attorney, one of the things I did to kind of create my website is I went around Manhattan and I took all these different photos of the Brooklyn Bridge, of downtown Manhattan. And one photo I took, which I didn't put on the website, but I've kept in my office, is a picture of the Brooklyn Bridge. And then if you pan a little bit to the left, the absence of where the Twin Towers stood. I left the Manhattan DA's office in 2004. I then been a private practicing attorney. I've been working in compliance for years. And one topic, and the topic of today's discussion, is something that has eluded anti-money laundering compliance, financial crimes compliance, that other aspects of risk management have been more successful at. If you take credit risk management, for example, you can't get a loan unless you have a credit score here in the United States. And there are other countries that have very similar types of credit risk information sharing, so credit risk can be managed when giving a loan, a credit card, et cetera, to a person. But in financial crimes, and the topic and the guests I have joining me today are very, very relevant. Jim Richards is a longtime practitioner in the space of compliance. He's worked at the largest banks in the world. He was one of the instrumental people in bringing together others at other larger institutions to look at after 9/11 as banks were dealing with fighting money laundering and building compliance programs, how the banks could share information in ways that were allowed, but were helpful to the financial institutions, both individually as well as collectively. But there's always been a challenge. For some reason, we share information as financial institutions with one another and with the Equifaxes of the world, so we can sidestep credit risk in a better way by sharing that information. In information and cybersecurity, I was at a conference probably 2 years ago, and I was struck how information technology specialists, cyber crime specialists, are very bold in the information they share, in the data they collect and across various systems. FSISAC is a very well-known consortium of financial institutions to really serve as an effective roundtable for information sharing, for getting ahead of the cyber criminal. But in information sharing in the financial institution space, in the anti-money laundering space, there's been a much different level of progress or lack thereof. And so Jim's been doing this for decades and really trying to build from traditional information sharing, bringing people together to try and share it and stay ahead of it. And he's worked with, over the past few years, some very neat technology firms. And one of those technology firms is Duality Technology. I came to meet Alon Kaufman, CEO and co-founder, about 2 years ago. And I was struck by the proper balance that he was able to achieve in protecting privacy of the information that is shared and is allowed to be shared by financial institutions with one another, but the collaborative nature that his technology, because it's encrypted, because the various privacy laws are allowing the financial institutions to collaborate in a secure way. So I asked them to join me for this podcast and really discuss what the problem is, what the new potential solution is, how the regulators are seeing it, and maybe how we as a marketplace, and whether it's financial institutions, whether it's the regulators or the policymakers or the technicians, how we can finally come together and really start sharing information in a collaborative way that does put the cyber criminal or the financial criminal on their heels. Great. Guys, thanks for joining me. Jim, Alon, really appreciate the time. Where I want to start with you guys is the Economist article. The article that came out in April of 2021, and it really put kind of at the forefront the question is anti-money laundering, everything that's being done to combat it, is the process broken? For the listeners, whether it's the layperson, the law student, or the compliance professionals, you know, we've spent so much time. I've done nearly 20 years of this. I started at the Manhattan DA's office in September of 2001, a week before 9/11. And here we are on the eve of the 20th anniversary, and the Economist drops this article on us. The BSA was passed in 1973. And now an article comes out that announces that anti-money laundering is maybe a failed proposition. Jim, let me start with you. What do you take of the article? Where are we as a financial institution society fighting this? Where are we as an economic society, a marketplace trying to fight this? And do you see a path forward?
Well, I do, Paul, and again, thanks for having me. People don't talk about the general deterrent effect of all the various national AML regimes that we have, and I think that needs to be discussed. And I know the Economist didn't discuss it, but I think the interesting thing about the regime that we have, and we'll probably focus on the U.S. regime because it's pretty typical of most, is it was almost designed to fail. Because the whole purpose of it is to fight sort of global crime, global corruption, or even local or national crime and corruption. And those folks don't operate at a single financial institution. They don't operate within a single state, within a single country. They're operating all over the place. And yet the regime that we built is a very single institution, single jurisdiction, private sector on the one hand, public sector on the other hand, regime. And so I think if we're ever going to be able to make strides in fighting financial crime, we have to fight it like the financial criminals are operating. Cross-institutional, cross-jurisdictional, public-private sector information sharing. But the one thing that we have to do that they don't have to do is we have to preserve privacy and protect the information that is being shared within those new regimes.
What I've seen and what I've found remarkable on your career is you started at the basics of trying to get everyone in a room. Some of the larger institutions, those that saw more information, really probably had more ability to control the levers to try and stop bad actors as they kind of progressed through other financial institutions with the consortium. We've seen other technologies. I know Verifin has something that's 314B related. I know that others have tried to do it. And now, Alon, you are doing something with Duality that I find, I mean, it warms my heart of what you're trying to do. You're trying to let the institutions collaborate, but in an environment that does not trip up, whether it's GDPR or some other US state privacy requirement, or the financial institution's own risk tolerance or lack of risk tolerance. Tell us a little bit about how you've been moving through, particularly these past 18 months and where you are. I know that you're working with Oracle. I think that's dynamite, but how do you think, and I think you have the toehold that we've never been able to accomplish before?
Excellent, and thanks, Paul, for having me. Yes, indeed, Duality operates in a field which is called PETS, Privacy Enhancing Technologies. And really the essence here is that you can do collaboration between different institutes and work together and do information sharing in a privacy preserving manner. Without going too technical, there are novel technology advances in the recent years. Homomorphic encryption is just one of the names, which specifically allows basically to work on the data while it's encrypted. So essentially what this technology allows, it allows banks to start to collaborate between them and broaden the investigation, to Jim's point, so banks can have a broader view of activity or cross banks or cross geographies in a privacy preserving manner. And we all know that any local bank sees a very, very partial view of what the financial activity is going on. So this need to do the sharing is critical. But on the other hand, we also live in a world where we want to protect privacy. And these technologies and what Duality is doing basically allows Bank A to query Bank B or to query a consortium of banks on a specific account or specific transaction without ever disclosing who's really behind that account or what is the customer's name. So basically it allows you to perform these investigations, create these suspicious activity reports that are so common in the AML space and in the financial crime space in a way that you don't have to disclose, or the bank doesn't have to disclose who's under investigation or any other private information of the customer.
Jim, in the prep for this, we were talking about the sharing of information, whether it's by cyber or information security professionals or on the credit risk management side. On credit, financial institutions have been sharing credit for over 200 years. The credit risk score obviously is something that is embedded in US debt origination modifications, et cetera. We know, we all have credit risk scores. The rub internationally is some people who try to come here who don't have credit risk scores have a very hard time getting credit, and there's actually solutions being offered to get those credit scores so we can allow them in the marketplace. Why have we had such a difficult time, given that there's such there's so much incentive for us to share information, and duality notwithstanding, and the opportunities that they're providing? But why have we had such a hard time? 314B is near 20 years old. Why haven't we been able to crack that nut?
Well, I think part of it, Paul, is 314B, which is a section of the USA Patriot Act from 2001. I'll back that up a little bit. So the Patriot Act Section 314 was titled Cooperative Efforts to Deter Money Laundering. And it provided for two things. The first was 314A, which was public to private sector mandatory information sharing. So that's where the public sector, primarily FinCEN, law enforcement through FinCEN, would provide target names to designated financial institutions and ask them to sort of review those through their customer and transaction system. But that was a mandatory regime. 314B was the private to private sector, bank to bank, let's call it, voluntary information sharing. So a financial institution had to voluntarily sign up if it wanted to participate. And then once it was signed up, another participating financial institution could query it for a customer or a transaction. But it's that voluntary nature, Paul, that I think has really put the kibosh on everything. Because if a financial institution doesn't have to do something and doesn't do it, they cannot be found liable by their regulators. But if they sign up to do it and don't do it well or even perfectly, they can get into trouble with their regulators. So that's why only 40% of banks and credit unions are actually taking advantage of this provision.
That 40%, and the rub is 40% are signed up, but how many are actually using it? And then those are actually using it, how many are actually using it well or using it enough?
Not many are using it. Of the 40%, and 40% of banks and credit unions is less than 4,000. And there's probably about 500 or so that are active. And those that are active, and I know this from my time at a big financial institution, you don't use it very much, and you generally only use it with your peers. But here's where I really think that we were lacking. That same 314B that was passed in 2001 allowed for associations of financial institutions to share information, to form a formal association, get that approved by FinCEN, and then you could use 314A to bring a target in, and they can share information amongst those association members. 20 years later, we believe there's only 7 of these formal associations that have been created.
Do you think we'll ever get to a point where it will be mandatory to share this information? And not necessarily manually, but maybe in an automated fashion, that central repository, that private sector FinCEN will have the security protocols around it, the safe harbor around it, so that the information must be shared and therefore queried and used as an additional due diligence tool?
Must and shall are tough words, Paul, but I really think that if we really want to make a difference, then yes, the voluntary information sharing should be mandatory, so long as we have the ability to protect the privacy and the, sort of the PII aspect of it. And as Alon mentions, I mean, the technology's there, the privacy enhancing technologies are there, and we've seen it with what the folks at Verifin are doing and what Duality can do with its homomorphic encryption. We can protect the information and do those cross-institutional collaborative investigations.
So I think it's going to be terrifically difficult to mandate it. But Alon, for you, making it actually something that I know as a financial institution I can engage in, get the data I need or to get the answer I need, while also protecting, any of the information that I might have available for the quid pro quo. But generally, how has it been going over the past 18 months, 12 months as you're getting into the marketplace, the work that you're doing with Oracle?
Sure. I just want to, before we dive into our last 18 months, I think, as we alluded to before, in the financial crime space, in the fraud space, we've seen more uses of sharing. And I think it's because it's easier for the banks to share, and the results are more direct and impact their bottom line. So if banks, specifically in fraud, if you prevent fraud, you impact your bottom line. And so there's an incentive beyond the voluntary or beyond the law stuff. There's a clear financial incentive to do it. And I used to work in RSA doing solving financial fraud and online banking fraud. And in that case, the ROI is very, very clear. In the anti-money laundering space, the ROI is less clear on a bank level. It's more a nation level. So that's one thing that we have to solve, the financial incentive for these organizations to do it. As well, if it's voluntarily and you can't see the bottom line, and it's also hard to do or takes a long time, so nevertheless, it's something that the adoption will be lower. And that's exactly one of the goals of Duality. Using the technology makes it automated, makes it easier, makes it quicker, and also preserve privacy. So that overcomes the obstacles of the privacy angles and making it easier to use and having an IT or a technology tool to do it. But we still have to solve the other side of it, which is giving the financial incentives to the banks. I think what we've seen in the last 18 months, and Jim also has a clear view in this area, is that we have seen not only more interest from banks to try and solve this in a broad sense, but we've also seen the regulators, and specifically FedF, pushing towards doing more information sharing, which in return, a lot more of the banks have started to look into these technologies. As I alluded to, they're called PETs, privacy enhancing technologies. And Duality itself, we've seen a huge growth in interest from banks and anti-money laundering providers. So as you mentioned, Paul, we are collaborating and integrating with Oracle. Oracle has a solution for anti-money laundering. And basically, Oracle and Duality together will allow any Oracle customer to query any other Oracle customer and build this, these suspicious activity reports and do these investigations much more efficient, much more quicker, and in a privacy-preserving manner. And we're going to create such consortiums and such networks, as we said, that will hopefully remove the technical challenges and the privacy challenges. We still have to, of course, create an incentive for the banks to do it on a financial level.
So for Mantis being the automated solution that Oracle provides to do surveillance over financial transactions, financial institutions each use the Mantis platform. The idea being Duality will then bridge the gap between all the different Mantis users. Is that fair?
Exactly. So a classical Mantis solution or the others anti-money laundering offers in the market look internally what happens in the bank. And I think the statistics show that only 25% of the financial activity of a given customer happens within the bank itself. So allowing within these anti-money laundering tools, within the Mantis tool, to investigate and query other banks is a huge thing. And what will come built in is the ability for any customer of Mantis that uses their investigation tool to query all other banks with the same technology in a seamless way and in a privacy-preserving manner.
What I've seen, Jim, over the past few years is a strong push by FinCEN to say, look, it's not just a querying tool if you get an alert that pops, but there's different ways to use it, you know, almost through the life cycle of the prospect through client relationship. Do you see that getting broader acceptance in the marketplace, that it's not just if you get your Mantis alert? And I'm in Mantis for a little bit. I previewed a question I have about other vendors out there and some interoperability. Alon, to preview a question in a few minutes. But do you see marketplace embrace of, wow, we actually can use this in onboarding and regular due diligence, CDD triggering events, things of that nature?
Oh, absolutely. It has to be the full spectrum because, you know, if you think of what anti-money laundering really is, it's simply reverse marketing. Think of marketing. What is that? Is who are our target customers? How do we get them into the bank? How do we keep them? How do we monitor their activities so that we can sell them more stuff and keep them as a customer? Well, anti-money laundering is just sort of the reverse of all of that, right? How do we identify the worst customers? How do we keep them out? Those customers that we do onboard, how do we find the ones that are actually the bad ones? How do we monitor their activity? We don't want to sell them more stuff. We want to exit them after we've filed our reports. So using the privacy enhancing technologies, they're sort of the soup to nuts in the customer relationship, has to be the future of the way to do this. But again, it can only be done. Alon, you make a great point that 25% of a customer's activity occurs within that financial institution, which means 75% is occurring somewhere else. How do you pull that 75% in? The only way you can do it is cross-institutional, and to really enhance it, public-private sector and cross-institutional information sharing and collaborative investigations. I think that's the other key point here, Paul. It's not just sharing of information, it's being able to do those joint investigations or the collaborative investigations.
How would it work at onboard? And this is a toss-up for either of you guys. I'm a compliance officer or a bank officer. A prospect comes in, never seen them before. How would it work using Duality, knowing, let's assume that prospect already has a financial profile elsewhere. How would I use that as a querying tool that would protect the other financial institutions that have that prospect's information, so I get what I need and no more, and the financial institutions on the other side that actually know that prospect are giving me enough that I need and no more on their side?
So a second, yeah, technically how it will happen, and then also practically. So what will happen within this network? is a new customer comes to you, you don't know much about him. You could now query all other banks in your network and get back results on a specific customer without disclosing who he is. Because obviously you don't want to disclose who he is because you may lose the business. However, you still want to collect the information, and you want to collect the information in a way that doesn't harm the other banks as well. So like simply or even querying, asking, has this customer been suspected, been flagged in any of the other banks doing suspicious activities? Or does this what are the sources of funds of this kind of account and so on? Or types of query you can do, where in our system, we basically, the different banks in the consortium agree on the types of questions you can ask. Because you can ask also very specific questions. And what's typically are asked in a know your customer environment or kind of yes or no answers that you don't even know what is the bank, which bank is answering. So you like spread the query to the consortium and get back the results without your ability to pinpoint and say, okay, bank B answered that and bank C answered this. And of course, in a way that you protect your customers. So that's how it's done with this technology. It's what's called privacy preserving queries, and without also allowing the responders to disclose too much information on their side. But I do have to mention here, because sometimes it sounds like this is a way to investigate things and maybe creep behind different walls. Everything in the setting using Duality and this technology, everything is agreed upon between all members of the consortium. So the types of queries, the number of queries, the entities that are querying, everything is known upfront. What is protected and protected by encryption is actually the queries themselves and the answers. So we make sure that the information is kept secret and private, but the setting of who's asking what and who's collaborating is of course known.
Do you have users right now using this through Mantis?
So yeah, we're launching the Oracle network towards the end of this year. There's a number of pilot banks on the way there, and we're launching the broader Oracle Mantis networks towards the end of this year. And we have similar kind of networks in different geographies as well.
The interoperability that I was getting to earlier, if what happens if you're not on the Mantis platform? Yeah. Because it takes an inordinate amount of effort to replace models. And so if this does have those network effects, so if you're a Mantis user and you realize that Duality offers this, what you've got your baked in network effect. But what about for those users that aren't on the platform, whether it's domestically or internationally? Is there any hope for them, or should they be moving over to Mantis?
Sure. So yeah, if you look at the grand scheme of things, we have to enable, and in order to fight the financial crime, we want to enable cross-bank, cross-geography, and even between banks and insurance companies and so on. So it's way beyond just the banking industry. We want to enable this world of collaborative analysis of financial crime. Currently, each of our customers have their own network. Technically, there's no limitation, but business-wise, we haven't set it up yet. But there's no challenge at all that a network of one customer can't interact with a network of another customer.
Jim, on the regulators, if you recall, and I won't name the bank, but it set the fines on a new level near 10 years ago with a near $2 billion fine. $10.5 billion of fines were levied last year per that Economist article. I think, what they say, an 80% increase from the year prior, 100-fold times being spent to actually fight money laundering than the actual amounts being seized. The regulators, what are you hearing? Obviously they want it, but how are they helping prime the pump, push the marketplace, US as well as international, into embracing this?
Well, internationally, the Financial Action Task Force has done quite a bit of work around information sharing. I think their last publication was November of 2017, where they sort of put together this, I think they call it the Consolidated Standards on Information Sharing. But in the US, we just passed the AML, Anti-Money Laundering Act of 2020. That was passed on January 1st of 2021. And there's a couple of provisions in there, Paul, that really came from the regulatory community, from FinCEN and from law enforcement. And that is sort of the opening section of that act, sort of sets out this, I think it was 6 purposes of the AML Act of 2020. And one of them was to encourage information sharing. And then there's a specific provision in there, section 6214, that calls for a study and a report by the federal functional regulators, the Attorney General and the Secretary of the Treasury, on how to encourage information sharing and that public-private sector partnership. So they're really pushing for it as well. They see that there's still a lot of friction in this bank by bank by bank by bank approach to fighting money laundering. They have to make the change. They know they've got the technology now to do it that we've been talking about, the privacy enhancing technologies. So I think we're going to see some big movement in the next couple of years.
And let me close with that. If we project ourselves, I hate to say 5 years because a COVID type event made us change our patterns and behaviors that probably would have taken 15. But for the sake of the question, what do you see? How do you see us fighting money laundering if the Economist did a follow-up article on this, say in 2026? And I'll first turn to Jim and then maybe Alon.
Well, I forget who said it. They said that they had predicted 8 out of the last 3 recessions. So I think I'm not very good at predicting myself, but if 5 years from now, if we aren't actively involved with mandatory, and I think it has to be mandatory, at least for the largest, sort of the globally significant firms, if we don't have mandatory cross-institutional public-private sector information sharing with those cross-institutional investigations, we will have failed. I'll say it as bluntly as that.
Alon?
Well, I'll take off from where Jim ended. I think that several years back, it was hard to mandate these things because there was a clash of information sharing and investigation and privacy. And we are living in a world where, if you look at it at a broader scheme, big data, the move to the cloud, data science and privacy are really clashing. Now, so it was hard to mandate it up until now, but because of these new technologies, it's becoming now possible. So it's now more possible than before that you can mandate it. I hope it will happen in 5 years. We know that things don't necessarily work so quickly, but this technology allows to mandate these things. And the minute they be mandated, they will be deployed. Already today, if we talk about 314B, which when it's done manually, it will take around 3 to 4 months. So even if you're voluntarily doing it, it's a very long and hefty process with a low outcome. If you can click a query and get an answer within 30 seconds, and it's privacy preserving, there's no reason why organizations won't be using it. If it's mandated, it will just be easier. And I want to go even beyond AML and financial crime. I think the financial industry can open the way to this information sharing around anti-money laundering, and it will hopefully percolate to other areas in the world as well. And healthcare is just another example where, for very different reasons, there's of course a lot of value of sharing data, but data is still very private. So I not only hope that it will be mandated and customers will be using it more and more, but it will also spill over to other industries, and we'll see a more collaborative world, when at the same time a much more privacy preserving setting.
Well, I think we've crossed the Rubicon with our need for the technology to get us lawyers, us compliance professionals, us lay professionals to finally use information sharing in a truly collaborative way that does protect the citizen and does protect the bank's own goodwill and and business plans and customers. On the cyber side, or the technology side, the oft used phrase is move fast and break things. And what I think you guys are doing, Alon, is you're helping us move fast and not breaking the wrong thing. So I want to thank you both for your time and I very much appreciate you being on. So thank you, and I'll see you guys soon.
Cheers, Paul.
Thank you very much, Paul.
Great. All right.